Welcome, traders. This is your host, Will Gomez, also known as FX Showtime, here for a quick explanation on Doji stars. Doji stars are just a type of indecision candle. Now, the first thing that I want everyone to remember is indecision candles are not to be feared. As a matter of fact, by their very nature, they represent a period of indecision. Right? A doji star is categorized by very, very little movement between the open and the close of the candle. Right? Very, very little movement. So for example, this little guy right here, right dead center, this is considered a doji star. It's got very, very little movement. It is a bearish bodied candle where technically the market opened at a higher price and closed at a lower price, but the movement between those 2 points was minimal at best. Now, this is a neutral doji star. Furthermore, it's neutral because there's about an equal amount of wick to the north and to the south of this candle, right? Doji star. Now, when we start to talk about bearish and bullish doji stars, again, please don't forget the fact that we are talking about an indecision candle. So there are 3 words realistically within the language of the candles, candlese if you will. There's bullish decision candles, which mean I'm going up, bearish decision candles, which mean I'm going down, and your indecision candles of all flavors, hanging mans, spinning tops, all that fun stuff of all flavors that realistically just mean I don't know. Okay, the market's not going to be doing anything super decisive based off them. However, this, for example, is an example of when you combine them, this is an example of a bullish doji star. Combinations of dojis can create a decision candlestick formation. This is an example of a bullish doji, and we've got a little bit further along, if I'm not mistaken, I'm pretty sure I saw an example of a bearish doji. Again, what qualifies it is that there's very, very little movement between the open and the close price. And now I can't seem to find it. But what we are looking for, the reason why this is considered bullish is because the majority of the length of the wick is to the south. So realistically, again, a candle has an open, a close, a high, and a low. On a bullish candle, a candle opens at a low price and closes at a high price. Right? The bulls are trying to make the market move to a higher high. The bears are doing the opposite, so they open at a high price and close at a lower price. And your wicks are extremes, where the market has been able to make it during the course of that time period. Your candle is a measure of price movement against time. So when your candle opens, if the bulls manage to make the market go up, you'll see the body of that candle go up. And if the bears decide to fight the bulls back down for control of the market, the candle will decrease. However, it leaves the wick behind as a memory, as a record of how far it's been able to go. When you have long wicks sticking down to the south of a candle, it means that the bears at one point tried to fight their way down to create a lower price point, but the bulls fought them all the way back up. They weren't having it that time. So when you get consistent wicks, long wicks to the south, it means that the bulls fought harder than the bears and they managed to make the market close back up at a higher price. The body of the candle may still be bearish, right? Because the market may have closed at a lower price from where it opened, but overall, something like this would be considered a bullish wick because the bulls were not allowing it to continue. All right. So the same thing occurs when you get long wicks to the north. When you get consecutive long wicks to the north, when you add dojis or indecision candles that have really long wicks to one extreme or the other, you're looking at the expectation. You're actually creating tweezer bottoms in this case, which indicate that the market more than likely is going to continue in the direction of the bulls, or tweezer tops in this case, which indicate that the market's going to be moving in the direction of the bears. Again, they tried to push it further. The opposing team was not having it, forced them back down. Tried to push the market down further. The opposing team was not having it, forced them back up. That is how you interpret your indecision candlestick formations. Again, your dojis are simply just the ones with the least amount of movement between the open and the close of the candle. This has been Will Gomez, FX Showtime.